All right, so you've given us a really interesting mix of sources today. We're talking AI, stocks, consumer spending, even retirement planning.
Yeah, you've got a little bit of everything.
Looks like you're looking to get the big picture on where the economy is headed.
Exactly. And you know how to position yourself for success.
So let's dive right in.
Sounds good.
We've got one discussion on the hottest stocks in that whole AI race,
Yeah.
featuring an expert portfolio manager.
Oh, wow.
Another conversation with business leaders about their outlook for the coming year, with a focus on consumer trends and potential government impacts.
Okay.
And then a segment on retirement planning,
Okay, yeah.
specifically for those of you in your early 60s, with tips on managing your 401ks and alternative investments. So by the end of this deep dive, you'll have a clearer sense of the economic forces at play, some smart strategies for your investments, and hopefully a few aha moments along the way.
Absolutely. It's all about connecting the dots between these seemingly different topics.
Okay, so let's unpack this. And let's start with everybody's favorite buzzword, AI. The NASDAQ is up. And NVIDIA stock has been on a tear. Now, even with a recent dip, it's still up over 450% in the past 2 years.
It's insane.
Yeah.
It's no surprise that investors are going crazy for AI stocks.
Yeah.
The technology is disrupting industries left and right, but picking the winning AI company,
Yeah.
it can be like trying to predict the weather. Even experts get it wrong all the time.
Oh, totally. And that's why our portfolio manager suggests a different approach. Focus on the entire AI ecosystem
Oh, okay.
instead of individual companies. And he's particularly keen on Accenture
Yeah.
as a bit of a sleeper pick.
Interesting. Why Accenture?
Well, they don't actually create AI, but they're masters at implementing it for everybody else.
Oh, so they're like the AI consultant.
Exactly. Think back to the cloud computing boom.
Okay.
Accenture was a huge winner there. They were helping companies make that transition. And they've got a whopping 734,000 employees already focused on IT services.
Wow, that's a lot of people.
So if a company wants to leverage AI, Accenture is ready to roll up their sleeves and make it happen.
That makes a lot of sense.
So rather than gambling on the next big AI company, investing in the company that helps everyone use AI, that could be the smarter play.
So it's like that saying, during a gold rush, sell shovels.
Exactly.
It's about understanding the underlying trends and positioning yourself to benefit from the wave, regardless of which specific company comes out on top.
Now, speaking of big tech, how does Meta fit into this whole AI puzzle?
That's a good question.
Their stock is up 40% in the last year,
Yeah.
which sounds fantastic on the surface.
Yeah, it's pretty good.
But, our expert sees some potential roadblocks ahead for Meta.
Such as?
Regulatory and litigation risks, uncertainty around their leadership, and some past decisions. Well, let's just say they raise some eyebrows. It might not be the smoothest ride for your investment.
Interesting. So even with those gains, there's some concern about long-term stability, especially compared to a company like Accenture.
Right. Accenture has a proven track record, deep relationships with its clients.
Yeah, that's true. It's a reminder that in the world of tech, a stock needs more than just hype. To make it a solid investment, you need to look at the fundamentals, assess the long-term viability.
All right, so we've talked AI, but let's zoom out to the bigger picture. What's the overall mood like, according to these business leaders?
Well, it's a mixed bag. Some are excited about the potential for deregulation, but many are expressing caution. Uncertainty seems to be the prevailing sentiment.
Interesting. Why is that? Aren't things supposed to be looking up?
Well, if we connect this to the larger global landscape, you've got things like tariffs, the potential for trade wars, and constantly shifting government policies. It makes it really tricky for businesses to plan for the long term.
And our sources highlight that with some specific examples. We've got one fertilizer company hesitant to build a new plant because of possible tariffs on Canadian imports. Then there's the general slowdown in business spending and consumer confidence. It's like everyone's holding their breath, waiting to see what happens next.
Exactly. And that uncertainty, that is a crucial factor for your own financial decisions.
Yeah.
When businesses hesitate to invest, it can create a ripple effect on jobs, economic growth, and even how the stock market performs.
Not quite time to build a bunker, but it definitely makes sense to stay informed and adaptable. Now, let's turn to the consumer. They're the heartbeat of the economy, after all.
Yeah, for sure.
What are the sources saying there?
Well, there are some bright spots. Coming from retail earnings,
Okay.
home improvement retailers seem to be bouncing back. Lowe's reported positive same-store sales growth
Wow,
for the first time in 2 years,
that is a big deal.
which is huge. And TJX.
JJX.
That's the parent company of TJ Maxx and Marshalls.
Oh, right.
They're crushing it, beating estimates with really strong sales.
People love those treasure hunt stores.
They do, and it tells us something really interesting. Even in these uncertain times, people are still spending, but they're looking for value. That strength in off-price retail, that speaks volumes.
Yeah, it does. Now, some major players are sounding a note of caution, though, like Walmart. They issued a pretty conservative outlook for the year ahead. Yeah. It seems like the consumer base that's driving spending, it's shrinking, with more affluent shoppers doing the heavy lifting.
Yeah.
And those rising delinquencies on credit cards and loans, well, those are a red flag. That some folks are feeling the squeeze.
Yeah, that's worrying. It's fascinating, though. We're seeing a two-tiered consumer landscape emerge. The well-off are still spending, but many others are tightening their belts. This makes consumer confidence a key indicator to watch. It can give us a sneak peek into where the economy might be headed.
So think about your own spending habits. Are you more cautious, putting off big purchases, hunting for bargains? If so, you might be mirroring a larger trend that's brewing in the economy.
It's all about connecting the dots. Your individual choices can reflect broader economic shifts.
Exactly. And speaking of smart decisions, let's move on to retirement planning, especially for those in their early 60s. Our expert says this is a sweet spot for retirement planning.
It is. You've passed the age for early withdrawal penalties.
Right.
From your retirement accounts, but you're not yet required to take those minimum distributions. It's a period of flexibility that you can really use to your advantage.
Okay, let's dive into 401ks.
Sure.
What are the key moves to consider?
First, you want to weigh the pros and cons of rolling over your 401k to an IRA.
Okay.
An IRA can offer more investment choices and control, but it might not have the same level of creditor protection as an employer-sponsored plan. It's important to understand those trade-offs.
Got it. So more options with an IRA, but potentially less protection. What else should we be thinking about?
Another option, especially if you have employer stock in your 401k, that's gone up a lot in value, is taking a lump sum distribution. There's a potential tax break called NUA, net unrealized appreciation. That can significantly reduce your tax burden on those gains.
Hold on. Net unrealized appreciation. I feel like I should know this, but refresh my memory.
Sure. Imagine you bought company stock years ago for $10 a share. Now it's worth $100. That $90 increase, that's your unrealized appreciation. If you sell the stock, you'd pay taxes on that entire gain. But with the NUA strategy, you could pay taxes on that gain at a much lower rate. When you take a lump sum distribution from your 401k, it could save you a bundle come tax time.
Okay, so it's like a special tax break just for employer stock
Right.
in your 401k, but you have to take the money out in a lump sum to qualify.
Exactly. There are specific steps you need to take, and it might not be the best move for everyone. It's about assessing your individual situation and goals.
Right, so it's worth exploring, but not something to jump into blindly.
Got it.
Now, even with that NUA strategy, sometimes just a good old-fashioned IRA rollover makes the most sense.
Absolutely. IRAs are known for their flexibility and accessibility. They offer a wider range of investment options than most employer-sponsored plans, and they're generally easier to manage when it comes to estate planning. And those eventual required minimum distributions.
Okay, so we've got options for managing our 401ks, and we're in that sweet spot for withdrawals in our early 60s. But what if we want to go beyond the stock market? What about those alternative assets everybody's talking about?
That's a great question. Alternative assets, they're projected to hit $24 trillion in assets under management by 2028.
Wow.
That's massive growth. So clearly something big is happening here.
Why are investors so drawn to these alternative assets? Is it just because they're trendy?
Not at all. There are some fundamental forces driving this shift. Remember how we talked about the shrinking pool of public companies? Investors are looking for ways to diversify. Beyond that limited pool, they're seeking opportunities that don't move in lockstep with the stock market, which can help reduce risk.
So it's like diversifying your portfolio beyond the usual stocks and bonds, spreading your bets, so to speak. But what kinds of alternative assets are we talking about?
Private equity is a big one.
Yeah.
In particular, secondary private equity, where you're essentially buying into existing private equity funds. It's a way to access those private markets with potentially less risk and a shorter time horizon than traditional private equity investments.
I've also heard a lot about real estate debt as an alternative investment.
That's another hot area right now. Real estate debt is following a similar path to private credit, after the 2008 financial crisis, it offers attractive yields and can be a good hedge against inflation. Plus, with interest rates rising, lenders have more leverage to negotiate those favorable terms.
Okay. This all sounds intriguing, but the world of alternative assets can feel a bit intimidating,
Yeah.
to be honest. Where do you even begin?
You're right, it can be confusing. That's where working with a trusted advisor can be so valuable. They can help you understand the different types of assets, the risks involved, the right allocation for your specific situation. It's about finding that sweet spot between risk and potential reward. A good advisor can be your guide.
So it's not just about chasing the highest returns. It's about matching your investments to your goals and your comfort level with risk. Now, for a topic that's a little different, our sources also mention this trend of companies scaling back their DEI initiatives. Diversity, equity, and inclusion were all the rage. But now some companies seem to be hitting the brakes. What's behind this shift?
This is really a reflection of a much larger conversation happening in society, and companies are finding themselves caught in the middle. It's about more than just corporate policies. It's about deeply held values and beliefs.
And consumers are paying attention. They're not just passively accepting these changes. They're voting with their wallets.
Exactly. We're seeing this rise in conscious consumerism, where people are making purchasing decisions based on their values. They're choosing to support brands that align with their beliefs, and they're willing to hold companies accountable for actions that don't reflect those values.
There's even a planned spending blackout
Mm.
on February 28th, encouraging shoppers to skip the big corporations and put their money into small businesses instead.
It's about more than just boycotts. It's about actively supporting businesses that are doing things the right way. It's about using your purchasing power to make a statement.
And it's interesting how the rise of these direct-to-consumer channels
Yeah.
it plays into this. Small businesses and creators have more ways to reach customers directly, bypassing those traditional gatekeepers.
This shift empowers both businesses and consumers. It allows businesses to build those authentic relationships with your audience, and it gives consumers more choice and control over where they spend their money.
It's like a whole new landscape for commerce, driven by values and direct connections. It really is fascinating to see how those consumer values, they're reshaping the whole marketplace.
It raises a really important question, though. Where do you stand on this whole issue?
Yeah.
How will this trend influence your own purchasing decisions? I think this is a chance to really examine your values and act accordingly. Your choices, even the seemingly small ones, they can have a big impact.
Yeah, absolutely. You know, it's a reminder that we're not just passive consumers. We actually have the power to shape the market with our choices. Okay, well, we've covered a lot of ground today, from the excitement around AI to those economic uncertainties, the importance of staying informed, and even how to rock retirement in your early 60s.
Yeah, it's been a great conversation. I think the key takeaway here is that knowledge is power. You know, the more you understand the forces that are shaping the economy and the market, the better equipped you'll be to make smart decisions. You know, for yourself and your financial future.
And remember, if you stumble across any more interesting articles or reports or, discussions, you know where to find us. We'll be here ready to dive in and help you make sense of it all.